session today. Thank you, everybody, for joining us. My name is Charlotte Fadipi. I'm the Chief Communications Officer, and I want to welcome you to, again, one of our stakeholder engagement sessions. The idea behind this is that we will meet regularly throughout the year, really because we want to get your feedback and thoughts on some issues that are of strategic importance to us. I hope that you feel comfortable enough to turn your cameras on so that we can see who we're talking to and get to know each other that way. But I do want to run through some housekeeping issues first of all. So as you can see on the slide there, if you do have any technical issues, because this is Zoom, that's always a possibility. So please take note of the number 916-399-3895. Perhaps write that down. And that way Swan and our technical team can help you if you have any technical issues during the meeting. We do have Spanish and ASL interpreters. There's a button there that you can press for interpretation, and that will translate what I'm saying into Spanish and into American Sign Language. So thank you to Yelka, Giovanna, Marlene, and Angela for helping us with that. If you do need closed captions as well, there's a button that you can see on your Zoom bar, and that will put the closed captions on for you as well. We hope that this will be sort of a fairly free-flowing, informal kind of conversation. But if you do have a question, please use the raised hands feature on your Zoom control bar. And if you're on the phone and you want to ask a question, please press *9 and then wait for us to call on you, and then you can unmute yourself and ask your questions. Again, we've allowed some time for this meeting, but just in case we don't address any issues or if there's something that is really technical that we need to get back to you on, please feel free to email us on calquakefeedback@calquakefeedback.com. We're recording this meeting, so we may make it available in future on social media, on our website, and by you staying on the line, that indicates that you confirm to consent to being recorded. So that's just the sort of general housekeeping. As I say, we want this to be a fairly free-flowing conversation. We did put some materials up on our website for you to read beforehand, because that will help inform this discussion, we hope. But before we get into the discussion, Joe Zuber is standing by to give us the antitrust statement. So, Joe?
The part that the part that we've all been waiting for here. So this is the antitrust statement, and this is a meeting organized by the California Earthquake Authority, which we refer to here as the CEA. It's possible that representatives of insurance companies, perhaps including both CEA participating insurers and those of non-participants, may be in attendance. Whenever there are meetings attended by representatives of multiple insurance companies during which the business of insurance is discussed, including CEA operations, it's important for participants to keep antitrust policies in mind and to abide by these policies. For that reason, when participating in this meeting, especially if you're an insurer representative, please keep the following guidelines in mind. First, an employer representative of an insurance company must not discuss that company's insurance business, including in the case of a CEA participating insurer, how that company conducts its CEA business. Secondly, an insurance company employees and representatives must not discuss the business of either a CEA participating insurer or a non-participating insurer. And finally, in the case of a CEA participating insurer employee, please don't discuss at this meeting how that participating insurer handles or services its CEA policies. Any discussion of that subject should be in a separate meeting or conversation solely between that insurer and the CEA. Also, let's remember that it's the individual responsibility of each meeting participant to ask the discussion be stopped if it should stray outside of these guidelines. And that's it. Charlotte, Tom, back to you.
Thanks, Joe. And don't allow our admonition to chill your participation and your sharing of your views. Just not about your individual companies. Let me first start off by reminding everybody, back on February 22nd, we had a short kickoff meeting that was really about logistics. How do we set these up to engage with you and get feedback from stakeholders in a way that's meaningful and helpful to our board and helpful to you as we exchange ideas. because fundamentally this whole stakeholder engagement program is designed to really bolster the relationship of trust and transparency between our stakeholders and CEA staff and our governing board. And to achieve that, one of the pieces of feedback we got last time was the Zoom format we used in the first one, which was a webinar format, created unnecessary distance between us and you as stakeholders, because we're on a panel and you're out in an unseen audience. So this one is now set up as just a straight meeting. And I encourage you, turn on your camera when you want to talk if you're comfortable doing that. It's not mandatory, but it helps give us a cue that you want to say something. And when you do jump on, if you want to say something, it would help all of us and people who may not have met you for you to identify your name and who you represent, what organization you represent. And if you're an individual policyholder or just a consumer interested in our business, just let us know that as well. The other piece of feedback that I got actually between meetings, which I found really helpful, is we want as not just a free-flowing conversation, but for you guys to all feel like this is, I hate to use the term safe space, but this is safe space. Like, share with us views and thoughts and ideas without feeling like we're trying to pin you down or stake you, make you feel like you're staking out a final position. This is a space where we can be free to exchange ideas and share feedback without feeling like it somehow becomes binding on you, your company, the people that you are here to advocate for and represent. So I think as long as we go into this with that understanding and agreement that it is an exchange of ideas, it is not a negotiation, it'll be a lot more fruitful, hopefully, for you, and certainly more informative for us. As a reminder, what we decided to do is instead of take on a whole host of competing objectives and topics, that we would break it up into smaller chunks, not to exclude in this session discussion of product structure and coverage options, post-event sustainability of CEA after a really large earthquake, or what our objectives should be around policyholder growth. But just kind of those topics, if you have thoughts that kind of correlate to the lead topics, by all means share them. But what you saw from the deck and what we'll go through, focus on what we view as kind of two very fundamental objectives and a series of trade-offs, which is how financially strong should we be, and how does that impact rate and rate predictability over time. So those two that are highlighted in yellow are the lead topics that we're prompting conversation about. The next slide, as you saw, those of you who had a chance to look at the slide deck, it's really just a series of policy questions that are designed to hone in on this. And before I jump in and prompt you, there are also a couple of white papers that are in the backgrounder material. You can go ahead and leave it on the policy questions. There are a series of white papers that we prepared last year in the summertime to help facilitate these kinds of discussions. And I think it's attachment 4 and 5 have some general information about what our lexicon is around financial strength. Claim paying capacity. Attachment 4 has just a summary of what we are talking about when we're talking about CEA's claim paying capacity and the different elements of resources that we can tap into to pay policyholder claims after a really large earthquake. So I recommend that to you if you haven't read it before. But for purposes of this one, there's also a white paper, I think it's attachment 5, that talks about the lexicon of return periods, because we measure our financial strength by reference to return periods, which is and Shauna can jump in and correct me if I oversimplify this, but basically it's an expression of the probability that our liability under our policies might exceed our claim paying capacity. And so when we talk, the simplest example is, what is the percentage risk if we had 1 in 100-year return period claim paying capacity? What's the probability in a given year that we're going to suffer losses in excess of that? So 1 in 100 is 1%. So in any given year, a 1% chance based on the stochastic earthquake models that we use, that we might not have enough claim paying resources to pay claims after a really big earthquake. And obviously, the higher our return period number is. We're currently managing towards a target of at least a 1 in 350-year return period of claim paying capacity. As the number goes up, the probability of exceedance goes down. And that's why, that's how the language that we use when we think about and talk about financial strength. So the first prompt, without further ado, that we love your feedback on, is what is the right level return period of financial strength that we should target, keeping in mind that there's some history in the return period paper that shows that over our 28-year history, that number, based on the policy decisions of different boards, has ranged from sort of a high of near 1 in 1,000-year return period claim paying capacity to where we are now, a 1 in 350. So, and I'm going to really be disciplined about allowing there to be dead air and awkward silence as you guys think about how and when you want to jump in and participate. But I'll stop talking now and invite any of you to start sharing thoughts on that.
And just a reminder, if you do have any thoughts you want to share on that, please use the Zoom bar to raise your hand. We'll call on you and unmute you. Or if you're on the phone, *9. And again, we'll call on you and you can unmute yourself and please join in.
And also just feel free. There aren't a ton of people on the call, so feel free to just unmute yourself and start talking, and then we'll play traffic control.
Well, Tom, I don't mind kicking it off, and I know my colleague Doug Heller has probably complimentary comments. I'm with United Policyholders, and we're a 32-year-old nonprofit based in California that has been providing guidance to California property owners on whether or not to buy earthquake insurance. And we were involved in a lot of the discussions that led to the establishment of the CEA, and we have worked very closely with your team over the years to try to help you do your job and provide a product that is going to do the job for the consumers we represent. So I just want to say on this one, we've helped your team do listening sessions. We have done, we've had our own people be focus group members. We have on our website, we host a series of publications to help people make a decision whether or not to buy earthquake insurance. And we have worked very hard to help your team over the years do that tricky balance that we recognize that walk you have to walk. And I just want to say a couple things about your financial strength. I think in our discussions with Glenn before he transitioned, we talked about a lot the fact that other residual markets, other residual plans use a much lower sort of 1 in 100 event that they reserve to. And we understand that in your view that would lead to pro rata payments. And what I want to say about that is I've always said when I was on your product enhancement advisory board many moons ago, people want to feel like they're going to get some money to make repairs out of this product. And you already have this giant obstacle of the deductible, which is why, we were very sad that you felt the need to have to get rid of the lowest deductible. And I understand it, but we felt like that was not helpful. Because you already have this elephant in the room where people look at it and say, I don't know what I'm going to see. So I had been encouraging you to think about any kind of first dollar coverage that would be available for, say, an engineering inspection or, a cash advance below the deductible. Just again, just trying to get to that argument that we hear over and over from people that I just don't know that I'm going to see any dollars here from this product. So, so I think, I guess that kind of leads me to say we'd rather, if pro rata is the potential result, we'd rather have that than nothing. So given how you've been trying to balance your challenges with expensive reinsurance and your capacity with wanting to sell policies, and we know you have sort of slowed down on your marketing because of that. We just want to restate, like we would love to see the needle move to where a lot more Californians have this product. And so we'd rather see people have something than nothing. And so that's why we feel comfortable saying we would definitely like you to go to a less conservative target. And I think that's about all I want to contribute at this point.
I hear that, and also remember to put our next session on your calendar on, I think it's May 30th, because product, that issue really embeds into those other competing objectives, which is product structure and the opportunity to create coverages like our emergency repair or enhance the kind of emergency repair cash out the door kind of coverages.
Yeah, I mean, Tom, I do need to acknowledge, I know that your team is doing what you can to be fiscally responsible and not, kick a can down the road and say, oh, well, we actually don't have the money we here that we need. And, I get that. It's just that, like, we just keep seeing the number drop of people who have this protection. And it's just a big, big concern.
Yeah, I hear that. Amy, do you mind if I ask a follow-up question?
Not at all.
I'm really interested in how your constituency views and understands the notion of pro rata and what that would look like potentially or mean to them at the back end after a really big cataclysmic earthquake. What's your sense of how the average consumer gets that?
I think the average consumer is cynical in general about it. I'm going to say. Second, I think that people were a lot more upset about the idea of assessments. I don't know if it was people or it was elected officials, right? When the formula was being, negotiated, there was a lot. And in the early years, I think a lot of people, when you would ask them, like, why won't you buy this? Mm-hmm. People did say, well, people would say, I'm not sure this entity is going to be fiscally strong enough, or they wouldn't use those fancy words, but they would, and then they'd say, and I don't like this idea of the assessment that I might get, dinged after I've paid all this money. So I think people are much more sensitive about post-loss assessments than they are about the idea of getting less than full coverage, because I think that people kind of assume that they're going to, I know that's just my cynicism. They sort of assume they may not get every dollar. So that would be my response.
That's really a good one. And I hadn't actually thought about the assessment correlating as much to pro rata, because that's really
it's sort of a different, right? It's not.
Yeah, but it's.
I mean, it's coming up a lot with the FAIR plan, obviously. So
yeah,
right.
And it should be in the conversation. And we talk about pro rata a lot, but our statute actually refers to pro rata or installments payments. Mm-hmm. Any thoughts on how people would view understanding that that we may need to pay them out over time? Again,
no, I don't think anyone knows that I didn't even know that was a possibility. And I would say there's a huge difference, and it'd be very easy for us to explain to people that their money's going to come in increments, because that's how it comes anyway with ACV and RCV, right? Mm-hmm. So people are used to that. You don't get it all at once, right? It comes over time. And so I think definitely you'd have a much easier time selling an installment concept than you're going to get less than what you thought, than the total benefits that you paid for.
Yeah. Is there a particular sort of break point where, as you think about less conservative financial strength, like where do you think kind of that we should think, or our board should think about that point in time where it feels like we might be selling kind of what
Illusory.
John Garamendi, when I first started in the early 90s, there was all that crappy health insurance, sort of fake health insurance, and he called it, junk insurance. At what
Right.
point do you have a sense of where that point is as we lower strength, where it just doesn't feel good, that you would be saying, yeah, that's a good product?
I mean, I'm going to say honestly, and I want to hear, I do want to give Doug a chance to speak. You already have this giant problem with the deductible, because that sort of, for a lot of people, they just cannot get over that. They can't. It's like they just can't. Oh, you mean I'd have to have $100,000? I'd have to cover $100,000 in damage before I get a nickel of this coverage. That's the simple analysis I think that most people do, and so they don't really get much beyond that. That's my view, but Doug may have a different view.
Thanks, Amy. It's
Thank you.
incredibly helpful and thoughtful. Doug, you've been invited.
Okay, sure. I'm happy to talk. Thanks, Tom, for organizing this, and Charlotte as well. I'm Doug Heller. I'm the Director of Insurance for Consumer Federation of America. I'll just start by saying that, you asked about the sort of what is your constituency, or whatever, think about this, or, how do they feel about this possibility that they might not have full coverage. My constituency, your constituency, everybody on this call's constituency doesn't have earthquake insurance. The vast majority of Californians don't have it because, well, I know that we all may, but most of the people in California don't, and in large part because it is so expensive, especially in light of all the other costs. And so I think that part of our obligation here is to balance this sort of financial stability question against, are we serving the Californians who we really want to have this coverage? And I don't think we are, with this very, very excessively conservative approach to the return period. What I think we have in this situation is a product that is so high priced that to ensure that everybody will get paid, that the only people who we can get into the book are people who are more well off, and therefore we're ensuring that the people who are most well off will get everything they need, and people who aren't as well off simply can't afford to get anything they need. So I think that has to be the basis and the sort of the lens through which we look at this. And the fact is that if we move to, say, a 1 in 100 or a 1 in 200, and so 1 in 200, I can't remember what the number was, but I think you have it as like a 0.46% chance that will ever happen. Whatever the number is, there's a much higher percent chance that you'll have a pretty severe earthquake that won't damage the claims paying capacity. And in that case, we want to make sure as many people can get their full claim paid. But right now, if we have a Northridge, but not a San Francisco fire, or San Francisco quake, that wouldn't destroy the claims paying capacity, we don't have enough people who are covered because they can't afford it under the terms that we've set with these really restrictive return periods. And for me, that's kind of where we should be thinking about this. I would much rather have many, many more Californians mostly covered in the event of the worst possible scenario, and totally covered in the much more likely scenarios than the situation which we have, which is a small number of Californians fully covered, even if a quake we've never even imagined happens. And that to me is just, that's out of balance. And I think that we should really dramatically lower the return period in order to increase the coverage for most events, knowing that if we have a quake that exceeds claim, even a 1 in 100 year event, we're going to have a lot more issues than just whether or not people are getting 85 cents on the dollar, or maybe not getting everything right up front and it's going to be spread out over time. I just think that we have missed we're missing our calling by doing it this way.
And
oh, you're muted, Tom. I think you seem to be speaking, but
Thanks, Doug. So you're saying, like, pull the lens really way back and start with a baseline foundational reset about the public nature of our purpose, and don't just hone in on financial strength of product that for those who can afford it, but actually kind of rethink very fundamentally our core purpose and true mission, right? To see if
so
we can...
That's right, with a caveat that I don't think that you have to, that they're mutually exclusive. We don't sort of just throw out financial stability. We have to be financially stable. We just have to understand what financial stability means. And I think what you were saying is certainly something that I think you and I have talked about, that the purpose, in my view, of the California Earthquake Authority is not to have a facility that is available, or that to make earthquake insurance available. It's to help make sure that as many Californians as need it can actually have earthquake insurance. It's not that they could buy insurance, or not that they have a right to buy insurance, but that they have the ability to. And we should be working toward that goal. It used to be that people had earthquake insurance because it was part of their homeowner's coverage. When that fell off, we shouldn't have suddenly said, okay, now all we want is to make sure people have a place to go to buy it if they can afford it. We still want to make sure that people can buy it. So that's the rethinking, and part of that rethinking involves reducing this return period. I think it's critical because, and one thing that I can't remember, I didn't see in the documentation, and maybe it's there, and I apologize if it is, but I think it's really important to start sharing, like, what happens to rates as we move the return period from 1 in 350. Shauna's head just picked up, so I assume that maybe there is a document like this. From 1 in 350 to 1 in 250, what happens to rates at 1 in 200 and 1 in 100? So we can really see, okay, what do at 1 in 350 are we seeing rates going up, but at 1 in 200 are rates actually coming down? I think that's part of this question, so we can really understand what the implications of these choices are.
Yep. Yeah, that's actually really, and Doug, that's exactly why we linked these two. The notion of rate stability with financial strength, because as you point out, they're linked, and you have to have them as part of the same conversation. Do you, as you think about our purpose and how our board should be thinking about our purpose, do you also kind of, when we talk about our purpose, we also harken back to what was happening in the residential real estate market, where, if there's no homeowners insurance market, there's not an ability to, in our housing finance system, to borrow money to buy or facilitate the sale of the home. As you think about our purpose, should our board be thinking even more broadly about those elements as well?
If I can pop back in,
Sure.
I appreciate it. We had a lot of conversation. We have had a lot of conversations over the years about why don't lenders require people who are in the proximity of a known fault to buy it, and the idea that if more people had to buy it, even though it makes some people's stress level go up on this call, that then it would be a little bit more of a, it was a bigger pool with maybe higher and lower urban and rural risks, maybe a little easier to keep the price at a decent point. That was something, but there didn't seem to be much appetite in the lending community for that, and it's a whole nother layer of confusion there. And I think because of the current home insurance crisis, I think the lending sector is already kind of going, wait, we were supposed to require replacement value, but we haven't really, I don't know how much they've been policing it. And now, like, to make people spend more on insurance when it's getting more expensive feels very untenable. So, but this, if we're going way back to, like, deep thinking here, it's true that a lot of our problems, that your problems, stem from being a monoline high risk provider, and that's just a really hard place to be.
Yeah, one territory, one risk.
Right.
Again, don't feel like this is the last opportunity to talk about those really important big picture issues, because we will likely end up adding on additional sessions later in the summer as we think about those kind of really big fundamental restructuring kind of notions. It'll come up some on May 30 when we think about sustainability. But Doug, did you want to jump in and talk about that element?
Yeah, I just see there are other people who want to talk. We'll let that happen and come back to it if it feels like it's critical.
Okay. All right.
Thank you. I'll go next, following up on Amy and Doug's comments. At a population level, it's hard to find how individuals would identify with a change in mission. But at the individual level, I think if you were to ask someone if a 25-year return period event happens and you get zero payout, how would you feel about that versus if a 350-year event happens and you get a partial payout? I think the US has not known an event across any peril above the 100-year return period in our recent historical past. Maybe Katrina is the most traumatic event. And I think if something like Katrina occurred and you told people you only get 60% of your payout because this is such a catastrophic event, people would be more understanding than the opposite, a small event where they're like, sorry, but you're below your deductible, so you're not getting anything.
Thank you for that. Do you are you an individual consumer or policyholder? Are you with a company?
Sorry, I forgot to introduce
Oh,
myself.
that's okay.
I'm Manuel Chiruz with Guy Carpenter, a reinsurance broker.
Great. Thank you very much. And that's, that comment really gets to, I started with a very glib overview of claim paying capacity, what return periods are, but really those comments highlight the fact that, and Amy and Doug's earlier comments highlight I think the fundamental need to do a lot of education around what catastrophe insurance is versus sort of routine risk insurance. And that we'll pick up on those themes also in the next meeting when we talk about product structure. Thank you.
Thanks.
Saren?
Hey, Tom, thanks. Sorry for getting here late. Yeah, a lot going on this week and next week, so apologize. Just to jump in real quick to point out, we sort of, it's been my understanding at least that the CEA was not actually designed to solve an earthquake insurance problem, right? That to your point, I think that, when it was originally designed, its purpose was to resolve the homeowners insurance crisis. And certainly what we've talked about in the past with regard to the claims paying capacity and the your CPC and such is really that this vulnerability following a major earthquake it's this depletion of most but not all of your capital, and then getting impaired, and then not having second event functionality. And how do we make the CEA really more sustainable, rather than just lowering the return period in and of itself without doing something to make it more sustainable, seems really not a smart move, and not something that we think is the right approach. We think we have to have a CEA that remains functional, even in and has a second event capacity, partly for that reason, right? That we have to that because you have to have an earthquake offer in order to have a homeowners insurance offer, and those two things remain tied. That needs to be part of this conversation, part of the thinking here.
Yeah, and it's that I'm glad you raised that, and that's one of the reasons I mentioned when we were looking at that bubble chart. Although we're focusing on CPC, financial strength, that's another bubble: sustainability and survivability of CEA, and our ability to maintain writing new and renewal business for the people who weren't in the affected area of a significant earthquake that starts to deplete our claim paying capacity. Do you have, when we think about claim paying capacity from the industry, and for those who don't know Saren, he works for the Personal Insurance Federation, a trade association.
Sorry, yeah,
it's our largest PIs. But do you have thoughts on the carriers' views on how theirs, because of the linkage between homeowners insurance from a PI and the ability to acquire a CEA earthquake? That's just a mandatory linkage that we have in our DNA. how do the carriers think about having their homeowners customer in a position where lower CPC increases the risk of a pro rata payout or the inability to get a renewal policy in the next year?
To be candid, I've not really had the opportunity to sit down with our members and talk about sort of that, how they feel about what the impact of a CEA pro rata would be on the homeowner. I mean, I would only speculate that certainly, in some ways, to the extent that the homeowner connects the two, and in some ways may feel that the carrier is somehow let them down as well, that would probably be a concern in that way. Because we see it now in the homeowners market when there's events and people are, we've had, since I started at PIF, and again, I wasn't thinking of this as testimony, so Sarah and Taylor, the Personal Insurance Federation, when I started at PIF, there was a lot of this, there was this issue around a lot of criticism about underinsurance, right? And there was sort of this idea that people, we can, not trying to say how, I don't know if there's any studies about how underinsurance occurs. There's obviously a sense, and I think many of us have friends and family who don't necessarily update their agent every time they make improvements to their home or things like that, and they want to keep their premium low. But whatever the reason, and then you have price surging in these big events, and so you have a lot of homeowners who end up underinsured. And when that happens, they're just mad that they're underinsured. That, whether they understood there was a pro rata when they signed up, whether they understood that they bought $500,000 of coverage. I need $800,000 to rebuild my house right now. And people just get mad about that. And then it becomes an issue, right? And they just start blaming whoever they want to blame. And that's going to probably be the insurer and the earthquake authority in this case, right? So I think that's just a normal human reaction that I think we need to be cognizant of. That people probably, as much as, to Ms. Bach's point, as much as affordability is important as well. Certainly, my observation in the homeowner side is, people sort of, when the worst thing happens, they want what they want, and they're not really in a feeling like they want to be very understanding about, getting less than that. So,
yeah, I'll be candid. I hadn't really thought about using the notion of underinsurance as part of the conversation around pro rata, because it does seem to have kind of the same implications potentially, and that's the way in which we talk about pro rata could be informed.
Yeah. I mean, you're thinking about it as just a financial reality, which is true. Yeah. But to the consumer, I think it's going to be viewed as an underinsurance to them. So anyway.
Guys, I just wanted to jump in for 1 second. We have Kate Stillwell, who also has now joined us, and she's been trying to raise her hand and all of that before, so I just wanted to bring her into the conversation.
Thanks.
Yeah, I provided some comments in written form, and my name is Kate Stillwell. I'm the founder of Jumpstart Insurance, and we introduced a parametric earthquake coverage for consumers that's still live. We have the uptake of that has not yet exploded, but in the process of the sales, we have talked to a number of agents and a number of consumers, probably in the thousands of consumers and the hundreds of agents. And far and away, the most common comment that we get is when we talk about earthquake insurance to folks is, I need something that pays first dollar coverage. And there are plenty of folks that we've talked to. So maybe, a quarter of the folks we talk to are folks who have wealth, and most of those folks buy CEA or CEA-like insurance that has the large deductible. And the product works well for folks who have assets and enough liquidity to be able to first pay the deductible and second want to protect their assets. But for the remaining 80% of who we talk to, 75 to 80% of who we talk to, and as you know, 88-ish% of Californians, it's really a liquidity trap of folks who are living, if not paycheck to paycheck, just extremely cognizant of when they can spend money on vacations because money is tight and getting tighter for a lot of reasons. So I want to just echo Doug's comment about thinking about the availability and accessibility of disaster recovery insurance, earthquake being the topic that we're talking about, through the lens of equity and how we, as a community of people who want to build financial resilience, how we make some level of coverage available to a large number of Californians for a moderate-sized earthquake, and trying to balance that with how much the product, how the products that are available serve the folks who already have wealth and assets. Speaking from the privilege of somebody who has wealth and assets, but actually is not a CEA customer myself.
We don't hold that against you. So your product is a parametric product, as I understand it, right? If you're within an affected area and there's a certain magnitude, the product pays out a fixed level of benefits. As in those conversations with customers, did you get insights into how those quarter who might have had CEA coverage, what level of understanding they had about CEA's financial strength and how they view us in terms of our ability to meet the moment and pay claims when the event happens?
Yeah, I'd say a minority of folks did make a comment. Maybe 1 out of 3 have made a comment like, I've been a CEA customer all along, and I'm not so sure that they're going to be able to pay everything. And maybe because they were a CEA customer all along, they looked into it when they first bought it and realized that the reserves weren't necessarily there at the beginning. But a majority have the presumption that the financial strength is adequate.
And do they, as you were talking to them about pivoting to different kind of products, it sounds like that 80-20-ish sort of split, really, it's, what did he call it? A liquidity trap?
Yeah.
But basically, it's just a cash flow,
cash flow
consumer household cash flow issue. Any sense of when we think about this moving from financial strength to rate stability, like what their feelings are about rate stability and I'll use the term volatility, the risk of significant spikes or more modest rate increases, say 6 or 7%. Any sense of where your constituents' breakpoints are, where they just say that's too much, I got to drop my policy?
Yeah, I'd say that among the folks that I've talked to who have CEA or CEA type coverage, I know we're talking just about CEA coverage, most of them have the resources to be able to keep paying for coverage, and they buy it as an emotional decision. So if you're rich enough to buy CEA coverage in the first place, you're rich enough to absorb rate increases for the most part. And I know that's a little bit counter to what Doug's platform advocates for, and it's definitely counter to what I see the governmental purpose of the CEA is to increase the accessibility of the types of products that are available. But if we're just talking about the current coverage, I would say that there is some inelasticity on the price.
Very very helpful.
I did have one other comment about your question, Tom, about the threshold, which is that just to make a comparison, just people don't have any notion of return period in their minds. It's just completely foreign. But if the CEA is able to say we're as financially stable as Citibank or as Lloyd's or as not that everybody knows Lloyd's or as typical mortgage company. Mortgage companies failed in 2008, but they're still alive. So then that's sort of like a point of reference. So
benchmarking the notion of financial strength against something different from just return period. Okay, hold those thoughts, because some of the other prompts that we have that'll come up involve rating agencies and the importance of that as a benchmarking of financial strength. So
thanks for the opportunity.
Oh, thank you for participating. It's really very helpful, and we appreciate it. Do we have more? Why don't you pivot back to the slide deck? And thank you very much, by the way, whoever's running our slides, taking the slides down while people were talking. I found that really helpful to be able to see people's faces. So, we've essentially covered off on both of these questions. The second question was really honed in on that notion of pro rata. So let's, Kate, if you feel like popping in and talking about rating agencies, this next series is really about how consumers, companies, insurers, producers react to our financial strength rating. Tom, did you want to? I can't remember whether. Yeah. Do you want to talk about history?
Great. Well, good afternoon or good morning. My name is Tom Hansel, CFO at the CEA, and great first policy question. Excited to jump into number two. This, Tom mentioned, this relates to financial strength ratings from rating agencies. We do have a document within that package Tom mentioned earlier, and that is attachment number 6. So it was about 5 or 6 pages of detail around the CEA with respect to ratings as well as broad ratings. And just a reminder, why are ratings there? And I think, Kate, a great point. It's there to provide that independent, objective view of financial strength for entities. And with respect to insurance companies, AM Best is, clearly the marker a lot of folks look at. As a reminder, CEA, though, has ratings from 3 different rating agencies. We have AM Best, which we currently have a B++, and that's related to financial strength, our ability to pay claims after certain events. And they do use return periods, that 1 in 100, 1 in 250. They looked at stress scenarios of one event and then multiple events. And then you have ratings we have from Fitch and Kroll. And those provide ratings related to our debt issuances. We issue debt on a long-term basis and a short-term basis, and to be able to place debt in public markets, those investors are looking to understand how that independent view is on our financial strength, our ability to repay the debt, not necessarily our ability to pay claims. So today's focus is really on the AM Best side, and thinking about our financial strength rating that we've had from AM Best for about 20 years now. And it had been an A- for years and years, and then we dropped a little over a year ago to a B++, which is 1 notch down, and that was driven by the reduction of our claims paying capacity return period from the 400-year floor to the 350-year floor, and we have a stable rating with respect to that right now. And basically, Best, as well as the other rating agencies, have said, as you reduce financial strength, we're going to reduce your rating. And so basically, it's not 100%, but every 50 years, we'll probably see a notch reduction in our rating. And all that's detailed in that paper. So, part of this right now is we're looking at, tied to the first question, how do consumers and how do insurers and ultimately how do producers, when they are discussing, offering, whether it's a catastrophic policy like the CEA or other players in that market, or just generally offering policies to the consumers, how do they think about a financial strength rating? How do they look at it with respect to the CEA and the type of organization we are? And we look forward to your input. I see, Doug, you've got your hand up first, so look
Yeah, I have
forward
a
to your
question for you.
insight.
It's a question for you, Tom. I mean, I have thoughts on this, but I first want to ask you. So, what is the AM Best rating of all of the other monoline, monostate, residual cat things? Because Texas windstorm, which is a monoline, monostate, I mean, it's 16 counties only, right? They have a 1 in 100-year return period, and whether or not they can do any post-event assessment doesn't have anything to do with their financial strength because it's still what they are. And so I'm just wondering, are they all in sea territory? The beach storm, the beach policies of the East Coast, and how are they surviving in that? How do their consumers respond to that?
Yeah, great point. They have all chosen not to have ratings, basically from inception. So TWIA that you mentioned, which is basically those tier 1, tier 2 counties that have a lot of wind damage, Citizens in Florida. You have the North Carolina and Alabama windstorm. So they've chosen not to, and you're right. They're sitting around that 100-year event, and depending upon each carrier, and we have a section on that later in the big package, how some of them have assessments, et cetera, to make up for that shortfall in the 100-year, if there was something greater.
And so I guess my sort of the following question is, because you're asking us sort of what are consumers, I mean, I think that there's probably some level and maybe of, I don't want a company that is where there are flashing red lights out there that says they're unlikely to pay my claim. But it's a pretty unsophisticated analysis that I think most consumers are capable of doing because we're not really trained in that kind of thing. I'm just curious if you have any research that shows that people in Texas or South Carolina or saying, whoa, we're not going to accept the TWIA policy or something because they don't have an AM Best rating. I mean, is there some evidence of that?
No, we've not seen any evidence. I don't think there's been a research paper of consumer behavior. Granted, it's a very different situation. As Amy mentioned earlier, you don't need an earthquake policy to get your mortgage. In all those other states, there's a requirement to have wind coverage to get your mortgage. So it's 100% take-up rate with respect to that. So the Citizens policy, there is no option, and you don't have that, economic term discretionary product. And so does that affect consumer behavior? It's tough. And we've asked a lot of partners we have. We know a lot of folks in those geographies. I've worked in those geographies before. And it's just a different buying behavior, but something that we can continue to think about and look at of how would that inform consumer behavior here, and does that impact take-up rate or not? If that's where you're sort of thinking about this maybe going, if we had or didn't have a rating.
Yeah, I mean, I guess I was curious if there was some evidence. I just think that AM Best is not. I think that we have a strong regulatory infrastructure. We have a sophisticated CEA staff that puts us in a position where we can be collectively being state of California can kind of be deciding what this, what the risk level of the product should be and not be handing it off to AM Best or not be I mean, I think there's useful information that AM Best and the others can provide that can be helpful to your team and the like. But I worry when we start deferring so much to these agencies when this is a publicly managed product with oversight that's different than, say, a private company that's solely kind of, that maybe the department has the financial solvency responsibility for, but they are dealing with a lot of different companies. We've got a whole infrastructure of oversight for the CEA. And so I tend to be less worried about what AM Best says and how that's going to impact things if we are collectively making that decision. If public policy is making that decision.
Very good points. I appreciate it, Doug. And when you put yourself in, as maybe as a consumer, rather than sort of rather than oversight and helping consumers, does that play into a personal decision, or do you, and do you think we can, how do we think about that specific behavior, and can we get some of that probably from some of the other folks in this call as well? But to you, Doug.
Well, my very short answer is I don't think from the consumer. I think the consumer wants to know that there is some mechanism for ensuring that we have a stable and sustainable and thoughtful, robust process for determining that this is the right way to sort of structure the CEA. I don't think a consumer cares if it's AM Best or the state of California or a stakeholder group that comes together of experts that have thought about it. I mean, I don't think consumers know anything about AM Best. Mm-hmm. So I think that we overvalue the name, and what we really should be doing is making sure that we're getting it right. And so I tend to think that if the state of California says we've got the CEA and we've worked for decades and are constantly refining to make sure it is in the best shape for you, knowing that there is risk involved with risk transfer, then that's what we need. We need that stamp of approval, not AM Best or Moody's or something else. We need the confidence of the state, and that's I think what we're looking for.
Yeah, and I throw in there that in connection with all the shopping help webinars that my organization has been involved in hosting and participating in over the last couple of years as people struggle to keep their homes insured. I have a slide that has if you have questions about the financial strength of a company you've never heard of, right, which is mostly the surplus lines insurers, we have like a link to AM Best and the phone number they can call. And I like to do these experiments just so that I know that what I'm saying is not just a load of hooey. So I've called the number, and it's kind of not something most consumers are going to be able to do. They're not going to do it. So I think that it's not really realistic to expect that consumers are going to have that level of depth or sophistication. And I think, again, I would support what Doug's saying. That I think for people to know, well, the governor's office and the Department of Insurance are part of the team that is managing the CEA. That should be that's more important to the average person than something they have absolutely no familiarity with.
Thank you, Amy. Appreciate that.
I see Dennis has his hand up. Hey, Dennis.
Hey, Tom. Thank you. Dennis Burke with the Reinsurance Association of America. I apologize. I've got a problem with my voice, so I hope you can understand me. I didn't know how and where to jump into this conversation, because I think ultimately, the CEA's original mission is one that Doug no longer wants it to follow, which was to resolve the property crisis caused by the make available mandate in the state of California. So the CEA's original goal, and that's why you have participating insurers, is to make available insurance in lieu of those carriers offering their own paper and putting themselves on risk for earthquake insurance. So if we want to change that's a policy decision for the state. And I'm not sure that's a policy decision for the CEA independently, but it is a consideration. And I think a lot of the things that we've been talking about we fall into what consumers want. I mean, consumers want essentially free insurance. I want essentially free insurance with the maximum coverage possible. So we know consumers want something that is difficult to achieve in rational economic terms. So this is a risk management process that we're doing, and I thank you for and your team for looking at it both from the risk management process and even earlier for the mission statement of the CEA as a whole. But that it has to fundamentally make sense economically, and I'm not sure if we've discussed every possibility of restructuring the CEA, but we should evaluate those issues in terms of everybody saying and I have no idea whether or not this affects my members positively or negatively, but I'm just gonna throw it out there that you need to have some deductible. You just do. Because particularly any sort of ground movement without a deductible requires would require the CEA to repair every house for every crack everywhere at all times. You just can't have that. We don't want it to be a maintenance policy. We want it to be a catastrophic policy. So you have to look at it from that perspective. And that's an issue that they see in the New Madrid region where it's more brick and mortar. So they have to do they would have to do repointing all the time. So you need to think about those issues. But there is a possibility to provide coverage at a sort of a co-participation level. So you wouldn't provide 100% excess of whatever the deductible is. You would provide, a different number. And do consumers want that? I know that would not be my first desire is to but if you could attach lower and get more value from the policy or perceived value, maybe you could sell more of them. But ultimately, we talk about equity, we talk about the need to keep the CEA as affordable as possible. These continue to be economic decisions. If inflation goes up, which apparently in the past 3 years, construction inflation went up 50%. 50, not 15. 50%. How do you deal with construction inflation when your job is to help people rebuild? If you're going to avoid acknowledging that inflation is affecting your equation, which is premium less losses and expenses equals whether or not we stay in business. I mean, that's really what it comes down to. So, before we start talking about other people's money, which is how we can achieve equity without you don't have taxing authority. So before we get to that, I think the question is, does the state want you to do that? Does the state want you to be the entity for providing a certain amount of insurance for the people who want to buy it? And that would be paid by the 88% who aren't insured. So is that what the state wants to do, is tax the uninsured to provide better coverage for the insured? I mean, these are difficult policy decisions, and I congratulate you guys for being willing to challenge them. But I think we need to look at that fundamental problem, which is every time we look to find money, it has to come from the people who aren't buying. And is that what we want to do? That probably wasn't as helpful as you want, but it's I didn't have a specific answer, and particularly because we think that your return period that you buy to is a business decision and not a governmental decision. We have not taken a position on that.
Your comments actually illustrate the fact that as much as we'd like to hive off just financial strength and rates, all of these things are related to one another. Can I ask, going back to your sort of original presentation of mission, do you see them as binary? And I'll confess, I don't necessarily see them as binary. Can you still solve for the original mission while pursuing strategies that seek to enhance accessibility and affordability and more take up?
Well, the answer is you've tried that. The CEA has tried that, and it's done a good job, largely benefiting as well from the fact that there have not been the significant earthquakes that would undermine its own financial strength, which is really what makes that possible. I think it's an issue, but you have to. You can try to accomplish it, but you recognize that within your own funding streams, you're putting inherent subsidies and tax assessments, whatever you want to call it. Somebody, a $10 billion earthquake is going to cost $10 billion. That's the answer. So where does the money come from? How does it get into the CEA originally, and how does it get paid out to claims? You may structure your policies and your premium equity, both the coverage as well as premium, in a way that has some inherent subsidies, so you can try to achieve that. But the question is that that's partly your board's decision, but is that going to work long term is really the question. And obviously you're trying to aim for long term, I would hope. So
if at first you don't succeed.
It's not an easy task that you're trying to undertake.
Doug, did you have a follow-up? And thanks, Dennis. Appreciate your comments.
Well, it was just a very brief note. It's something that Dennis and Saren also said about sort of the original mission and sort of the way I sort of see the responsibility of the CEA. So just putting aside the politics of the situation in the post-Northridge environment and the desperation, I don't think that the mission, however you lay it out, was to dramatically decrease the number of Californians who had earthquake insurance. So, but we now have something like half of the number of people covered than were covered under the prior conditions. And so the idea with the CEA was to make sure, yes, the homeowners insurance there would be homeowners insurance sales in California, but it was not to be, I don't believe, at the expense of the interest in earthquake insurance and the preference for coverage that predated that. So I just wanted to note that we had something like double the amount of people insured with earthquake coverage prior to the CEA. And so if we are falling short of that amount, then I don't think we really transitioned sufficiently, even if you can argue that the purpose wasn't to sort of bring in more coverage, more people, right? You can argue that it wasn't meant to expand coverage. I would like to expand coverage, but maybe you can make that. But I don't think the argument was create a system that destroys access to the policy, and cutting something in half is pretty destructive. So I just wanted to sort of add that sort of nuance in terms of the data. So we can do with that whatever you might, but I just think it's important to remember.
Well, thank you for that. Actually, as we think about, and just to remind everybody, the reason we're doing this stakeholder engagement is principally to help our board be really well informed about all of these diverse views as they think about mapping out in the second half of this year a long-term multi-year strategy to pursue a mission, which can be a mission that they as a board articulate now, not necessarily inextricably tied to something that happened now more than 30 years ago. So I'm really glad that people are commenting on and rooting conversations around our original purpose, but also where we are now is much different than where the market was. So that's And I guess it's not fair for me to always ask you follow-up questions, but and maybe I'll make Dennis do this, but just to bring it back to ratings, like we didn't have a rating before, I want to say 2002 or 3. In the early 2000s, it was related to our need to a desire to utilize revenue bond transactions to diversify and strengthen our claim paying capacity. And I think that was the impetus in the early 2000s for going out and getting ratings. And anyone have any observations about whether that was a material factor in changing how consumers, how the insurance companies, how the reinsurers even viewed working with us?
Since you sort of tossed this to me before we started, I don't disagree at all with Amy and Doug that the average consumer has zero idea about who AM Best is. I don't think that, when they are making their decision about purchasing insurance or reinsurance, I think it's, for most people, it's through an advisor. I don't know if you have a direct to consumer arm, but I don't think that the average person would have a knowledge of what a AM Best rating means. But the AM Best rating, at least in the industry world, is we refer to the rating agencies as the real solvency regulators. It's tongue in cheek, but the reason we're saying that is because they require a stronger financial capability for insurers to pay than the statutory construct in the state insurance codes. So some of these state insurance codes have, surplus to right property insurance of $100,000. I mean, that's clearly inadequate. So, between the states have up their game with risk-based capital and things of that nature to try to address these issues. But, for at least in the commercial market, it's the rating agencies that are giving the message to insurers, sophisticated policyholders, and to agents who is, more likely to have the financial wherewithal to meet the promises that they're making. And when you're dealing with agents, you're dealing with errors and omissions coverage. You've got concerns from their perspective that they are doing both. They want to do the right thing to begin with, and two, they want to make sure that they're not going to get sued for making a mistake. So having a rating agency rating, it's probably helpful for them from that perspective. But I'm not an agent, so I will, having speculated on that, I will pause.
Well, do your members pay any attention to our rating when they're thinking about what tranche of risk they may want to buy from us as we're in the reinsurance markets? Or are they agnostic to what AM Best?
This would really get into the speculative world because we try to succeed in avoiding underwriting decisions with our members just because of antitrust issues. So that you would be asking a question. I think that's a question that whether or not they're willing to discuss it publicly. The discussions with the people who know that are really the brokers, the reinsurance brokers who place reinsurance on your behalf. They actually have a better understanding of what the ratings are versus the probability of loss. My personal speculation is that the rating agencies provide some information, but I think partners, for lack of a better term, have been with you for a significant period of time, and they really have a good understanding of who and what you are.
And on that, we have talked to, as you all know, we have a massive reinsurance program, and we have talked to most of them, especially our key ones, and it isn't required with an AM Best. They would be fine if we have it, fine if we don't. They're doing all of their own analysis and understanding where they sit on our curve and the reinsurance they're providing. So that contingent, and that's why we don't have it for a reinsurance comment there, but with, and Doug definitely gets you, but before we jump to Doug, just if there are insurers or producers on this call that would like to provide their opinion on the requirement during the sale process, would love to hear your input. But off to you, Doug. Sorry about that.
Well, I wanted to just briefly say that. I mean, I think that you can think about three types of people who'd be interested in an insurer's sort of financial rating. So theoretically, consumers would want to know some security at this really this very kind of unrefined level. You have the reinsurers who want to know about it, and then you have investors. And I think if you were just pointing, and from what I understand, reinsurers have a very sophisticated ability and deep capacity to do the analysis they need to determine whether or not it's a good bet to engage with the CEA. Consumers don't have the capacity, as I think everybody has said, to really make heads or tails out of AM Best or any of these. So it's really a great tool for investors who don't have the resources to do the deep dive that a reinsurer could do, but do have enough at stake to want to know something. And yet shouldn't be a real concern. That's not that most of the sort of concerns that CEA have do not revolve around investors. There's a small amount of bonding needs, so maybe there's that, but I don't think that overcomes, or I don't think that is nearly significant. And certainly, of course, you don't have investors who are trying to make, gambling on whether or not you're going to be profitable. So I just feel like for our purposes, it's not as critical either for informing reinsurers to help them know where they stand, or for informing consumers just to understand the security. And that tool that it could be useful for investors is just not a major part of the CEA. And I understand there is some amount of bonding where people might want to do that, but I just wanted to note that it serves a part of the market that really isn't as much a part of this conversation.
I completely agree, Doug, and that's why I think this one here is really focused on AM Best. The Fitch and the Kroll, we will figure out strategically, depending upon what return period we sit at, whether, what we do with those ratings and how it impacts our bonding. So wholeheartedly hear you and agree with you on how to segment the various stakeholders with respect to the various type of ratings. So thank you. Saren?
Yeah, I think on that, it seems like it is more a reinsurer question here. Just my sense would be for certainly our members, they'd be much more concerned with the overall CPC than any particular, what the rating is. So I don't know that that's a huge factor for them in terms of, they're going to still partner with the CEA regardless of your AM Best rating.
No.
But what's driving a lower rating could become a concern,
No, which is a great point and a nice tease to say that they are interconnected. The way that the ratings are done, especially for natural catastrophe reinsurers, it is so dependent upon our claims paying capacity on a return period basis on a first and second event, and they have specific return periods. They say you experience one event, and then the next day you experience another event of a different size. What do you look like? And as we reduce our financial strength with respect to a return period, it's going to put pressure on our ratings. And that's where it gets to it. If ultimately the board, decides, hey, we want to adjust the rating or the return period, we want to be informed from you all so we can inform the board how our constituents and stakeholders think about this. So they appreciate the trade-offs when it gets to that point and saying, okay, folks care about the AM Best rating, don't care about the AM Best rating, or it's really just comes back to the financial strength, as you're saying, Saren. That's what's most important. And the the rating, is another data element, but really doesn't, impact how we should be thinking about all these other decisions we're making.
Right. Unless, and I'm not sure if Doug was getting at this, but if having the lower rating then drives your higher borrowing costs, and then that has a vicious, cycle for then driving up your rates that you have to charge consumers, then it probably starts to become a thing on that end too, right? So,
which is a great point. We've done the analysis, and it's there's a lot of, we could spend 2 hours just discussing that one topic. So, but I'll say we've done the analysis, and there's enough of a trade-off that if we, had the increased borrowing costs, but we reduced the claims paying capacity related to that, it's a net positive, for lack of a better term, in that we only can borrow so much capital from the markets. And so that's generally the trade. We can always spend more time on this at a future meeting if you'd like to.
Before we transition away from ratings and into the third policy area around rate stability, and which is I want to make sure we leave time for that. I will just observe, without revealing whether I've got a strong position on rating agencies and CEA's utilization of them. I cut my teeth in the insurance industry back in the early 90s, working for the Department of Insurance on a couple of large life insurance company insolvencies, First Capital Life and Executive Life, both multi-billion-dollar companies that failed at a moment when they were both holding A ratings from AM Best. So it's, ratings serve certain purposes, but they're not by any means a guarantee or that stands, that puts full faith and credit behind our policy. Anything more on that second policy question before we transition in the next half hour to rate stability?
No, but Tom, I just wanted to note, and I appreciate all the time, I'm going to have to leave in a few minutes. So.
Okay. Well, then let's let Shauna jump in, and if you have if before you have to leave, you want to make some general comments about your views on rate stability, feel free. But otherwise, we can let Shauna jump in and just lay a little foundation.
Okay. Thanks, Tom. So I can make this brief so we can get the comments on the record. First of all, before we spend even one more second, I have to acknowledge that today is the 118th anniversary of the 1906 earthquake. So there you go. All right, so on this piece here, there's just a few questions, obviously not meant to cut down the conversation. We're all ears on rates and rate stability, but just wanted to give you my perspective on the questions before we get the feedback. So the first question on rate stability, really what I would like to hear is, what is that number? Like, is rate stability, the rates don't change, or is it, up to 5% that's still viewed as stable, or is it something a little bit higher, something a bit lower? So that's kind of the first question. But again, not to limit the comments, but that is really what I'm interested in. And then on the tolerance for reduced financial strength in exchange for stable rates, we've had some conversation around that already. Doug, your comment about, well, how do the rates respond? Obviously, the rates are very sensitive to reinsurance costs and the financial strength assumptions. And in attachment 10, there is a table that describes kind of how that plays out on a very structured set of assumptions, which is nobody really responds one way or the other. Obviously, if rates go down, we would hope people would come in, and if rates go up, people will probably leave. But on a very structured set of assumptions of no response, it's about 12 percentage points of rate for each 50 years of return period, just to kind of give you a sense of how that plays out. And the question here is around that, obviously, and we've had some discussion on it, but also around what if, rather than having a set target of 350 as a minimum, for example, we say, well, if the rates are going to go up by more than 10%, we'll drop our strength so that we can maintain whatever that rate stability number is. whether it's 5 or 7 or whatever. And so have a more flexible, as opposed to set the assumption and then get the result, let's balance and try to keep our rates stable. So that's kind of what that second question is about, but again, not to limit conversation. And then the third question really is about, well, the rating structure itself. Like every other insurer, we do use location, not as refined as some of our competitors. We do use building characteristics. We've kind of exhausted those, but kind of a sense of how people feel about us having a more refined rating structure, which clearly would mean some people would pay more, some people would pay less. In earthquake world, it's not a zero-sum game. If we find something that actually is more relevant to the risk, it doesn't necessarily mean that everyone that goes up, anyone that goes up, it's got to have an offsetting down. And I think I just did my hands backwards there, but hopefully you get the point. So just some commentary around that would be helpful as well. And with that, I will open the floor for comments.
Well, I guess I'll happy to kick it off here. I mean, I think obviously from insurer perspective, the goal is to have an actuarially sound rate where the rates reflect the risk. And if at a fundamental level, your question is how much of a solvency risk should we put ourselves at to just maintain low rates? I don't think that's something that an admitted insurer would even be allowed to consider. You have your solvency requirements, and you can't just keep lowering your claims, your financial strength, and your claims paying capacity to hit some sort of target, because you can't control the external factors, like inflation, like risk exposure. You can't control those. So by just weakening your financial strength in order to keep rates low, at the end of the day, that seems like a losing proposition as a business. So again, our focus has always been on increasing the financial sustainability and the long-term functionality of the Earthquake Authority, and that should be the primary focus here. Not sort of, not to say that obviously affordability isn't an issue or a concern, or how do you address that? But I think you can't just continue to think that you can just keep low rates, keep rates low regardless of what is happening out in the real world. It's just not a real practical way to run a business, So I'll leave it at that for now. But
and I have to go, unfortunately, but I would say just these two very brief things. One, with respect to the point by Saren, I think that we maybe make a mistake if we start thinking, oh well, we're at 1 in 350, we were at 1 in 1,000, then 1 in 400, 1 in 350, so we can't just keep on going down. Let's start the conversation with what would rates be if we were at 1 in 100, okay? And then how much can we go? How much can we take in terms of increases over 1 in 100? In other words, instead of saying, oh, we're just shaving, we're decreasing solvency, let's do what all the other monoline, monostate residual markets do, 1 in 100, and then start moving up. How much more solvency do we need because of our conditions? And then think about the rate that way. I think it was a different conversation. It's actually the same conversation. It's just looking at it from a different perspective, because we are starting in such a disadvantaged position from the consumer perspective, because we have this excessively conservative return period. The last thing I'll say, just with respect to something Shauna just asked about, how much more granular should it be? My view is that the purpose of insurance is not risk segmentation, it's risk pooling. Segmentation is a tool, but it shouldn't be the priority. It shouldn't be the absolute goal. We want people to be in the pool. We want to have, and we want to spread the risk. So I think that we want to be careful of being so granular that we're thinking that we're pricing each individual individually. We are trying to create a risk pool. So let's not overdo. I sure don't think we should get to such a granular level of segmentation that that we make it too difficult for some people to get in the pool. There is some spreading of risk that we should be expecting. So I suspect people might have thoughts or disagreements or whatever on that. Unfortunately, I won't be able to hear them. So thanks very much.
It'll be recorded for you. Hey, Doug, thanks for your contributions. Really appreciate it.
Bye-bye.
Dennis, did you have your hand up?
I do. We saw Catherine box lit up, so I just giving her an opportunity, but she it's no longer there. In terms of the rate stability issue, I agree with the comments made by Saren. The CEA needs to collect, an adequate premium for the risk it's taking on. That's, the path to insolvency is has long been paved by people who charged an adequate premium. The second part of the question forgets the soft reinsurance market. So you're looking at reinsurance costs only in the scenarios where the reinsurance costs went up, and that has upward pressure on rates. The reinsurance market softening over an extended period of time for the companies like the CEA probably helps facilitate the rate stability that you had in light of inflation, because the reinsurance market and its view of the risk went down during the same time period. So that you could look at all of these things on a one-off basis in terms of, if reinsurance rates go up or down, can we accomplish X, Y, or Z? Or you could look at it as what is the ground up risk that you're taking on, choosing a premium for that, and using the arguably the profits when the reinsurance market goes down to help offset the eventual increase in costs when the reinsurance market goes up. So there's a lot of moving targets, but there, ultimately, I think you really need to have a strong enough, and I agree with this, a strong enough claims paying capacity. So that way, I disagree that anybody who takes a significant deductible, such as the CEA policy, I don't think they want to also have a truncation of the coverage that they provide. I think under all circumstances, anybody buying a policy with a 10 or 15% deductible is hoping to collect in full on it. So I think you need to look at it from that perspective, because otherwise, if you're going to squeeze the coverage on both ends, you're really having in my view, that's a sales issue as well as an ability to recover financially and economically as consumers and the state. And then from the reinsurance perspective, I mentioned that we're not going to pick a point for you. We want you to be careful and prudent, and it truly is a risk management exercise for you and the state to look at where is the right answer for, because the state has to decide what it's going to do after a major earthquake, or multiple major earthquakes. Because obviously, if you have a major earthquake slip, there's a possibility, and it certainly is probably a possibility all the time, but some of us think that we know what we're talking about when we don't, about the probabilities increasing that perhaps a major earthquake slip in the north can perhaps trigger a large or a significant earthquake in other regions of the state. So I mean, all that has to be put into it, and I don't think and just to Doug's point about starting at a 1 in 100 and going north, we don't have a lot of practice at earthquake catastrophe modeling, other than the fact that we did it. We don't have like some real world experiments we've been modeling these risks for a long time, and there's significant risk of what we call model miss. I don't know which way the model will miss, but that it's not a perfect example. It just is a mechanism that enables you to engage in your risk management and for companies to evaluate whether or not they want to put their capital at risk by reinsuring it. So I think that there's tremendous value to it, but don't get wedded to a particular percentage number. So that's just a word of caution.
That really, thanks, Dennis. That also tends to highlight elements of the discussions that we'll have on the 30th around sustainability and different competing objectives, and your reference to model miss and how people view a product really kind of highlights the nature of our product as a pure cap product, without the benefit of 20 years of consistent claim paying history that helps inform rates on a go forward basis. We just got to use the models and but know that they're providing a range as opposed to an absolute outcome.
Anybody else got any questions or comments on this? Please raise your hand or feel free to chime in. Not seeing anyone.
Wow, the thing that interests me most gets the fewest comments. Bummer. Or maybe everyone's just exhausted after the financial strength and rating agencies conversations.
Well, as I said, for those of you who didn't chime in, this won't be your last opportunity to talk about financial strength, rates, rate stability, rating agencies. All of these will essentially collaterally come back up as we get together again. Now, one of the things we want to do in all of these sessions is to not just limit ourselves to the topics, the focus topics that are at the forefront of a discussion. So that big black question mark is, are there additional comments and thoughts that you want to put on the table? And this actually relates to the next slide. As we use the last couple minutes, we've got more time if anybody wants to share more, but this is going to be a conversation and a series of engagements that ideally should build on each other and inform each other. When we get to May 30th, the focus topics will be coverage, and as I mentioned to Dennis, this opening up of notions of what a cap product should look like and how product structure can impact our views of financial strength and rate stability, and then growth, which gets to the comments that Doug and Amy and Kate were making, and then finally sustainability. What kinds of changes could we potentially think about making or pursue as part of a strategy to ensure that we're not just here to write the book that we have right now, but even after an event that affects us significantly financially, can we continue to write renewal policies for the people who weren't affected? Can we continue to write new policies for people who suddenly become aware of the value proposition of having a cap product like earthquake insurance? So just open question, are there other topics that we haven't thought about as we put together our bubble slide of 5 competing objectives that you want or want to suggest that we put on the table. Don't feel like this is your last opportunity to do that. You can always communicate with us however you want to. If you have thoughts after this about a topic or a subtopic that you think we should open up discussion on, by all means, reach out to any of us individually or to our comment channels that we have.
Hey, Tom, Dennis again. Thank you. On sustainability, that's obviously, you know, a key topic. You know, that again, this gets into, you know, your risk management and how you approach it. The CEA is largely essentially put all of its capital at risk for each and every year and buys reinsurance and other layers atop that. Which is a good way of, you know, because the reinsurance is further from the risk. That typically means that you would get a better price for it because you're further from the risk. But in terms of sustainability, the CEA, by the time the reinsurance is hit, the CEA has no capital for the next year. So we've looked at some of those issues in the past, but those are the issues that we need to be looked at again. Equally important, Doug brought up the concept of risk pooling. There's risk pooling and risk spreading, and there's risk aggregation. If you look at a map of where the earthquake risks are in California and compare it to the population of California, there's a lot of correlation there. So there's a very significant amount of, as you grow in population count, yes, you will pool the risk, but is that pooling beneficial because it's creating additional risk aggregation? You need to find, if you're going to do that, you need to find a way to transfer and spread that risk in some way, because otherwise it will be counterproductive to holding your rates down, which is not your only objective. I know you have many polls that you have to balance, but I just wanted to make you aware that is a point that perhaps is you know, a separate discussion for maybe for the board is have, you know, some expert come in and don't always like academics to come in, but you know, they're generally perceived as not having an economic interest in the discussion to discuss, you know, the whole pooling versus risk, you know, aggregation issue that you know, maybe an issue that the board would benefit from.
Thanks so much for that, Dennis. Appreciate it, and really great points. I did want to address your first one, and if you look at our towers, you know, that we produce, it can be a little misleading. We try to make sure it's clear, but we don't have all of our capital exposed for that event. Our reinsurance attaches as low as a little bit over $2 billion, and then starts to go there. So we, you know, we try to build some sustainability for those smaller or medium-sized events, so we have capital to trade forward. And it changes, the sustainability changes as the event size increases. And ultimately, clearly, with the blowout event, all of our available capital plus risk transfer or capital from revenue bonds could be exposed and utilized. But I think it's a really good point to set up that third bullet point of sustainability, how to look at sustainability, how do we utilize capital, how do we use third-party capital to protect equity under certain scenarios, but there's a trade. As you rightly put, Dennis, that as you cede, or for those who don't know, cede, basically are sending more of our risk to our reinsurance partners, that cost increases. But there's a trade-off with that for our sustainability, for our ability to provide policies and be deemed a going concern by the Department of Insurance after that large event or mid-sized event or smaller event. And that, I think, will be a great discussion as we move into May 30th, and clearly as we continue to prepare our board to make some of these decisions as we roll into the rest of 2024.
Hey, Tom, thanks for that clarification. I actually knew that. When you look at your tower charts, there's that blended color that reflects that. Kudos to you for working on layers like that.
Thank you, Dennis.
Yeah, thank you. And actually, all of this helps us inform what we'll put into the prompts in a slide deck and send to all of you beforehand so that you can be thinking about contributions. So when we talk about sustainability, we'll make sure that we include prompts around getting people's views on utilization of reinsurance as an element of maximizing sustainability. And then and we'll also throw in prompts about pooling versus spreading, and some of which is covered under in some of the background materials, but this is very helpful. And then, the last bullet is, well, before I get to the last bullet, I'll say I have found the last hour and 50 minutes incredibly helpful, and I suspect that our board will similarly greatly appreciate the level of thought and contribution that we've gotten from everyone who's participated, and even if you didn't actively participate, just knowing that you're there to listen in on the dialogue is very, very helpful. So we want to keep this momentum going on the 30th and continue to get the benefit of everybody's feedback. And if there is anything that we can do to help you think about these issues and feel like you're at the table with us as we grapple through the balancing of multiple competing objectives and initiatives, let us know. Either now or in the future, let us know if there's anything else we can do to help you and your constituents think about these things. So until May 30th, we will target to get another slide deck out, and if we supplement materials, they'll show up on our website on that page that aggregates all of the information for the shareholder or stakeholder engagement sessions. And we'll, if you've given us your contact information, we'll also look to email that out to everybody before the meeting. So you have a couple different avenues to get background information and help you prepare for seeing you May 30. Charlotte, is May 30 also at 10 o'clock?
I believe it is, Tom. And just to let people know as well, this we are recording this session, of course, and so we'll also put this recorded session up on that webpage as well in the next couple of days or so people can access it there, because like I said, it's been a fascinating discussion. But yeah, May 30th, 10 o'clock. And if people keep checking that webpage, they'll find all of the background materials, etc., needed for the next discussion, which I hope will be just as enticing and engaging.
Okay, thanks again for your participation. Any final thoughts, comments, questions before we end the Zoom and let you go back to your day? We know this has been a significant investment in time, both in preparation and participation, and we really appreciate it. And I think I can safely speak for our board to say that they really appreciate your investment in us and our long-term success.
Thank you for inviting us all.
Anytime, Dennis. Thanks. All right, with that, why don't we go ahead and wrap? Thanks again. We're here if you need us. We look forward to talking to you and seeing you again on the 30th of May. Thanks.
Thanks, everybody. Have a good day.